We've been looking at for a while, and actually, like there are a couple of people that I know who are executives at smaller companies, and especially in the resources space, they're cutting costs everywhere. Executives are taking pay cuts, and they're issuing shares to staff rather than having to pay out salaries and things like that. But the two fixed costs are registry fees and ASX listing fees. And so I thought, well, they're two pretty defensive companies. So we had a look at the ASX and we had a look at Computershare. And Computershare is one of those companies that it actually generates about 80% of its earnings offshore now. So it's a real Australian sort of success story, I suppose. And what we liked about Computershare, well, there are a few things. One, firstly, is the resilience of its cash flow. Secondly, it hasn't got a lot of debt. And in the US in particular, where it gains a majority of its revenue, they have exposure to US interest rates. So when a company's going to pay a dividend, for instance, they'll lodge cash with Computershare. Computershare will put that on deposit and collect a margin on that deposit. So as interest rates improve in the US, Computershare's revenue will improve exponentially as a function of that. So that's what we like about Computershare. So we think it's got good leverage to that theme, but in the meantime, it's a defensive business. It's trading on about, I think at the moment, I haven't had a look in the last couple of weeks, but I think it's 17 or 18 times earnings. So it looks expensive versus the market, but I think that's because it's got that leverage.